Varun Beverages up more than 230% in just a few years. Dixon Technologies up around 125%. Deepak Nitrite close to 250%. Three completely different companies, three completely different industries, but one common pattern. In each case, before the stock moved, something very specific happened on the balance sheet. The company started expanding, adding plants, adding machines, adding capacity, and the market for a while mostly ignored it. But when the capacity started becoming visible, revenue started climbing, profits followed, and then, only then, the stock got up. The price move came after the capex, not before. And that's the whole game. Because if you can find a company while the capex is still happening, that's where the early money gets made. That's exactly what we're going to cover in this video. We found 5 companies where serious capacity expansion is already underway or where new capacities are very close to going live. Because that's when things get real. So stay with me till the end as we'll be breaking down what each company is building, why it matters, what could go right and what could go wrong. Now before we start, throughout the video, we will be tracking 2 important balance sheet numbers. The first one is net block, which tells you the value of a company's physical assets like factories, plants and machineries after depreciation. In simple words, what's already built and running. Second, we are going to talk about CWIP or capital work in progress. This tells you how much money is being spent on under construction projects and is not yet operational. So together these two numbers tell you exactly where a company is in its capex journey. Now let's get right into it with stock number 1, which is Lupin. Most people think of Lupin as a large Indian pharma company. And yes, at a market cap of around 1 lakh crore and a stock price near 2,300 rupees, this is a well-established business. But here's what makes this interesting right now. It's not about Lupin getting bigger, it's about getting smarter with where it's putting its money. Let me explain. Most pharma companies grow by making more of the same medicines, standard generics. But here, margins are thin and competition is brutal. Lupin is moving away from that. They are focusing their capex on complex generics, things like injectables, inhalation products, and peptide-based drugs. These products are much harder to manufacture, so naturally competition is lower, entry barriers are higher and margins are better. You can see this shift on the balance sheet too. Lupin's net block has increased from around 9,700 crore to nearly 11,300 crore in just 1 year. And CWIP is relatively low at around 695 crore rupees, which means many of the projects under construction are now getting completed and becoming operational. A big part of this expansion includes the Dabhasa facility focused on complex manufacturing. Now on the spending side, they are putting in roughly 250 to 300 crore every quarter, which makes it about 1,000 to 1,200 crore annually, which works out to be around 4% of sales. Not aggressive capex but very focused. And the impact is visible too. FY26 EBITDA margins improved to around 29.7%, up nearly 6% year on year. That kind of margin improvement usually means the product mix is getting stronger. Now there are 2 other things you should know. 1. Lupin recently received US FDA approval and launched an epilepsy treatment oral solution in the US market. And 2. It partnered with Zydus Lifesciences to co-market semaglutide in India, which is basically the molecule behind drugs like Ozempic. This gives them early entry in what could become very big over the next few years. But yes, there are risks. The US generics market is very competitive, pricing pressures continue, and regulatory scrutiny from the US FDA remains a constant risk across the pharma industry. Now let's move on to stock number 2, which is Bajaj Auto. Now most capex stories work like this. Company spends a lot today, hoping growth comes in later. But Bajaj Auto works differently. At a market cap of around 3 lakh crore and stock price near 10,500 rupees, Bajaj generated roughly 59,000 crore in revenue. And the total FY26 capex was just around 500 crore, that's it. That's very capital efficient. Now, if you look at the balance sheet, you will notice net block jumped sharply from around 3,700 crore to 13,300 crore. But this jump is largely because of consolidation and asset reclassification, not purely fresh capex. So where is the actual investment going? Into core manufacturing, the vendor ecosystem and EV expansion, especially Chetak and electric three-wheelers. And the results are strong too. Despite commodity cost pressure, EBITDA margins improved to around 20.5%, which tells us pricing power, product mix and operating efficiency are stronger. Now there are 2 major growth drivers you can look at. First, exports. Bajaj holds over 46% market share in India's two-wheeler exports, and markets like Latin America and Asia continue scaling well. Second, the EV business. Chetak has crossed 5 lakh units and EVs now contribute over 20% of domestic revenue. So it's not a side project anymore, it's a meaningful part of the business now. Now, one more important thing investors should monitor carefully is KTM. Bajaj has indirect exposure to KTM through peer Bajaj AG. KTM is currently going through restructuring and Bajaj has committed significant capital to support the turnaround. Now, in the short term, this could create some pressure on profitability, but if it succeeds, this could strengthen Bajaj's premium motorcycle positioning globally. But there are risks which are industry-wide: increasing competition from both traditional and new players, supply chain disruptions, and input cost volatility. Now, let's move on to stock number 3, which is Varun Beverages. Pepsi bottles, Pepsi cans, Slice, Sting. VBL makes and distributes all of it. But it is more like an infrastructure company that happens to sell drinks. Think about what VBL has built over the last few years. 53 manufacturing facilities, 90% plus of PepsiCo India's sales volumes flowing through their system. This is a massive physical distribution and manufacturing network that would take years and thousands of crores to copy. And here's the interesting part. VBL is now entering a very different phase. The heavy investment cycle is mostly done. Management has said that India capex for CY26 is expected to stay below 500 to 600 crore because sufficient capacity is already in place. The focus is now shifting from building assets to using them. You can see this very clearly on the balance sheet. CWIP, which represents capacity under construction, has fallen sharply from about 1,922 crore to just about 271 crore in 2 years, which means all that construction is now completed and moved into the net block, which has roughly grown from 13,400 crore to 16,700 crore. So in simple terms, the investment is done, the factories are running, and the question now is purely about how efficiently those assets perform. And the early numbers already look strong. In the first quarter of this year, revenue grew 18%, EBITDA grew 21%, and EBITDA margins expanded to 23.3%. Management also shared an interesting detail. Older production lines ran at around 200 bottles per minute, but the newer facilities run close to 1,000 bottles per minute, that too roughly with the same manpower. VBL is also targeting around 30% ROCE with a 3 to 4 year payback period on investments. International expansion is another key focus area. The company recently opened a manufacturing complex in Zimbabwe and continues expanding across Africa. But international expansion also creates new risks: forex volatility, geopolitical disruptions, and execution complexity in newer markets. Now let's move on to stock number 4, which is Mankind Pharma. For years, Mankind built its entire business on one core idea: make medicines affordable and distribute them everywhere, not just metro cities but everywhere. Today, the company has 18,000 plus field staff, access to over 5 lakh doctors and more than 12,000 stockists, and the number 1 position in the Indian pharma market by prescriptions and number 2 by volume. That distribution network is one of the deepest in Indian pharma. Its stock price is currently around 2,543 rupees, but now the company is evolving. Mankind is now shifting toward chronic therapies and specialty segments. But why does this matter? Because chronic medicines for diabetes, heart problems, respiratory issues are consumed for years, sometimes even lifelong. That means more predictable, recurring revenue, better margins, and stronger doctor relationships. And the numbers show this shift is real. Chronic share has grown from 28% of the business in FY18 to nearly 39% in FY26, excluding BSV. Now, the biggest trigger here is the BSV acquisition. BSV adds a strong portfolio in women's healthcare, fertility, and biologics. These are segments with higher entry barriers and better profitability. On top of that, the company has also partnered with global pharma players like Novartis, AstraZeneca, and Roche. Financially too, FY26 was strong. Revenues grew 17% to 14,278 crore and EBITDA increased 15.5% to 3,499 crore. The domestic business excluding consumer healthcare grew nearly 15% and consumer brands like Manforce, Prega News and Gasofast continued scaling well. Now interestingly, net block remained almost flat around 19,000 crore. This tells you something important. Growth is coming from better utilization and business mix, not from heavy new asset creation. Capex is gradually increasing from 531 crore to 757 crore in a year. This is mainly directed towards manufacturing expansion, specialty capabilities, and BSV integration. Now, the challenge here is execution. Moving from mass market generics to specialty pharma is much harder. It requires deeper R&D, stronger regulatory capabilities, and stronger doctor engagement. Export growth also remained slow in Q4 due to geopolitical disruptions, which is also something to watch here. Now, the last stock on our list is Zydus Lifesciences. If there is one number that tells the Zydus story right now, it's the net block. It had almost doubled from about 13,100 crore to 26,600 crore. That is a massive increase in physical assets. And it shows one thing very clearly. Zydus has been building aggressively. But what exactly is it building? The company is shifting toward branded products, chronic therapies, biologics, biosimilars, and specialty products. These categories have better pricing power, higher margins, and lower competition. Already, more than 50% of revenues come from branded businesses. The India business is doing well. FY26 India formulations revenues rose to around 65,740 crore, and chronic therapies now contribute 46% of the Indian portfolio. The company has recently launched some high-complexity products like semaglutide injections and Tista. Now, in the US, Zydus is the third largest generic company by prescriptions with over 435 ANDA approvals. North America revenues crossed 11,600 crore in FY26. The company is also moving deeper into specialty and rare disease therapies. The assertive acquisition focused on oncology supportive care therapies in the US. On capex, FY26 spending stood at around 1,715 crore, and management plans to continue investing steadily. Financially, revenues grew 17% and EBITDA margins remained above 31%. And most importantly, growth was broad-based across India, US generics, wellness, and international markets. But yes, the risks are real too. US pricing pressure, regulatory scrutiny, biologics, execution complexity, and acquisition integration risks are all important to monitor right now. Alright, now let's step back and look at all the 5 companies together. These are 5 very different companies in 5 very different situations, and that's actually the point. So the takeaway here isn't simply that net block is going up. That alone means nothing. Now what actually matters is where the money is going, why it's being deployed, and whether that investment eventually can improve growth, margins, and competitive positioning. Because capex creates value only when execution follows. That's the filter to always keep in mind. Which of these 5 companies are you tracking most closely? Tell us in the comments. If you found this video helpful, do give it a like, subscribe for more such videos. See you in the next one.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.